Welcome back to the Wall Street Podcast.
Today we're doing a deep dive into some key reports, primarily from the Wall Street Journal, published this Monday, September 29th, 2025.
Yes, and we're really zeroing in on three main areas for you, the knowledgeable investor. We got conflicting economic signals, some sudden stress in credit markets, and new tax and regulatory mandates.
Right. Our goal is to distill the essential data points from these complex developments.
Okay, let's jump in. First is economic tension. Q2 GDP revision, it came in at 3.8% real growth. Looks pretty healthy.
It does on the surface. But the gross output, the go-go, tells a rather different story.
How so?
The go-go, it captures all transactions, not just final output. And it showed growth slowing sharply, down to just 1.2% overall.
1.2%. That's a big difference from 3.8.
A huge difference. And critically, real business spending actually fell, an annualized 5.6% drop.
Wow, 5.6%. That really does sound like a recession warning, doesn't it? Much more than the GDP number suggests.
Exactly. It aligns much better, unfortunately, with some of the weaker labor market data we've seen recently. It points to underlying issues the headline GDP might be masking.
And if business spending is falling that hard, I imagine that's spilling over. We're seeing stress in credit markets.
We are, quite suddenly, in fact. Two unexpected bankruptcies just hit a subprime auto lender and a parts supplier. And that's making bond investors pretty nervous.
Understandable. Especially with the backdrop of the, $2 trillion private credit market?
Precisely. And within that space, we're seeing more companies issuing payment-in-kind distributions, PIK, instead of cash interest.
Paying debt with more debt. Never a great sign.
It signals serious cash flow problems. One high-yield analyst apparently used the analogy of being stuck in the Star Wars garbage chute. Things are getting compressed.
A vivid image. Okay, so if credit risk is spiking in some areas, how do we square that with this other anomaly? The fact that AAA corporate bonds, even Microsoft's, are trading at negative spreads to treasuries, yielding less than government debt.
Yeah, it's counterintuitive, right? It seems to break a fundamental risk principle.
So what's driving it?
It appears to be largely technical, driven by huge demand from index buyers, pension funds, institutions that have to hold this top-grade corporate paper. There's simply not enough supply.
So it's a supply-demand imbalance overpowering typical risk pricing. They're chasing scarce assets.
Essentially, yes. Prioritizing that specific type of liquidity, perhaps, over the absolute yield level compared to treasuries.
Okay, let's shift gears slightly. This underlying economic pressure, the potential slowdown suggested by the Go, how is it impacting corporate strategy? Specifically around AI and jobs. We hear a lot about Walmart, Accenture.
Right. Well, Walmart executives have confirmed AI will eliminate some jobs and definitely reshape others. They're saying the impact is, quote, just starting to ripple through, but expect more significant changes in the next, say, 18 to 36 months.
And Accenture.
Accenture is reportedly taking a more direct approach. They're apparently exiting employees who can't be retrained for new roles while simultaneously creating new positions like agent builders, people specifically hired to build AI tools.
So restructuring is happening now, which brings us to personal planning, especially for high earners. There's a new IRS final rule on 401k catch-up contributions. What's the immediate impact there?
This is significant and starts next year. Workers aged 50 and older who earn more than $145,000 in the previous year. They must make their catch-up contributions into Roth accounts, after-tax accounts.
Must. So no choice between pre-tax and Roth for the catch-up portion.
For that specific group and that specific contribution type, no choice. It's the first time the tax code mandates Roth savings like this. It removes a pretty significant pre-tax deduction that high earners often use.
That's a major shift in tax planning strategy for those affected. Okay, we've hit market signals, corporate shifts, tax changes. How does this translate down to the general public's wallet? Any immediate impacts?
Well, the most direct potential impact right now is probably in the pharmaceutical sector. Today, September 29th, was a key deadline related to the Inflation Reduction Act.
The drug price negotiation aspect.
Yes. Drug makers face pressure to potentially reduce U.S. prices, and the administration is apparently considering pilot programs to benchmark Medicare and Medicaid prices much closer to global levels.
What kind of impact are analysts expecting?
There's concern among investors about aggressive use of the IRA framework. Talk of potential discounts, maybe 30% to 50%, on widely used drugs like, for instance, Ozempic.
That's substantial, a major policy risk for the sector's valuation, and potentially, eventually, for consumer costs, too.
It absolutely is. It highlights how policy risk can directly impact both investors and the public.
So navigating these signals requires, well, careful analysis.
Critical thinking is definitely essential right now, given these conflicting data points.
So wrapping this up, what's the key takeaway for your portfolio this week? What's the core decision?
I think it boils down to a long-term calculation. You see the Jirgo suggesting a potential recession. You see the new mandatory Roth catch-up changing tax dynamics for high earners.
Right.
So do you prioritize building predictable long-term tax structures? Or do you keep chasing yield in these, frankly, frothy and potentially risky private debt and tighter spread credit markets? That's the trade-off to mull over.